Investor mindset: how to build wealth. When we dream, we usually have big dreams. This is because there are so many things we want to buy or achieve in life, whether it's a beach house, a BMW, or a piece of land on the moon. But then we realize it's impossible to amass such wealth in our lifetime and begin to compromise our dreams. True, wealth cannot be created in a single day. But it is possible to create wealth over time if one is consistent and disciplined in their investments. This video will discuss a few steps you can take to build wealth over time. Are you excited? Then make sure to watch till the end and subscribe to Shareholdr for more. Here we begin! Save smartly. Saving is the first step toward building wealth. When we say save smartly, we don't mean saving whatever you have left at the end of the month. Rather, it means learning to manage your expenses in such a way that you can save the amount you want to save every month. The simplest way to accomplish this is to set aside the money you want to save each month as soon as you receive your paycheck. And you manage your monthly expenses with the remaining funds. For example, assume your monthly salary is Rs 1 lakh and you want to save 30,000 lakh each month. So first you put 30,000 lakh aside as savings or investment. The rest of the money, 70,000 lakh, is then used to cover your monthly expenses. Also reviewing your spending habits regularly to see if there is any room for additional savings. The most important aspect of building wealth is to be consistent and disciplined with your savings and investments. Automate your savings. So first, you set aside 30,000 lakh for savings or investment. The remaining 70,000 lakh is then used to cover your monthly expenses. In addition, review your spending habits on a regular basis to see if there is any room for extra savings. The most important aspect of wealth creation is consistency and discipline with your savings and investments. You can replicate that process with your IRA with a little preparation. Connect your bank account to your IRA account and set up automatic transfers. Some employers allow employees to deduct money from their paychecks for their IRA. Inquire with your employer if this is a benefit at your workplace. Another advantage of auto-saving plans is that you don't have to think about your retirement account as much. You may wonder why ignoring your account is beneficial, because you don't want your hands anywhere near the sell button when the market is tanking and your account balance is declining. Investing in stocks entails weathering the storm, and setting your savings on autopilot can help. In addition, stock market crashes are a great time to watch a puppy video or two. Manage your debt. You're not alone in carrying a balance from month to month. The average American is in debt for more than $90,000. Of course, not all debt is created equal, and some, such as mortgages, may be even considered good debt due to their low interest rates and potential for wealth accumulation. Some experts even consider a mortgage payoff to be a type of forced savings account because you will almost certainly receive a portion of your monthly payment back when you sell. However, if you carry a lot of bad debt such as high-interest credit card bills every month, you may jeopardize your financial goals. That's why, according to Gross, it's critical to have a repayment strategy in place with the ultimate goal of living a debt-free life. If you need help figuring out where to begin, consider the debt snowball or debt avalanche payoff methods. And keep in mind that it is possible and often preferable to save money while paying off debt. As your balance decreases, you'll have even more money to put toward your emergency savings and investments. Invest money. Once you've saved some money, the next step is to invest it so that it can grow. The risk and potential return on investment vary. In general, the higher the risk, the lower the potential return, and vice versa. If you are still getting familiar with the various types of investments, spending some time learning about them is worthwhile. While numerous exotic investments are available, most people will want to start with the fundamentals: stocks, bonds, and mutual funds. Stocks are ownership shares in a corporation. When you buy stock, you are purchasing a small portion of the company and will benefit from any increase in its share price as well as any dividends paid out. Stocks are generally thought to be riskier than bonds, but the risk varies greatly between corporations. Bonds are similar to a company or government IOUs. When you purchase a bond, the issuer promises to repay your money with interest after a set period of time. As a result, bonds are generally less risky than stocks but have less potential upside. Simultaneously, some bonds are riskier than others, and bond rating agencies assign them letter grades to reflect this. Mutual funds are collections of securities, most of which are stocks, bonds, or a combination of the two. When you purchase mutual fund shares, you are purchasing a portion of the entire pool. Therefore, the risk of mutual funds varies depending on what they invest in. Diversification is the most important investing concept for beginners, or any investor for that matter. Simply put, your goal should be to distribute your funds among various types of investments. This is due to the fact that investments perform differently at different times. For example, bonds may offer attractive returns if the stock market is losing ground. Conversely, stock B could be on a roll if stock A is down. Because mutual funds invest in a wide range of securities, they provide some built-in diversification. And if you invest in both a stock fund and a bond fund, or several stock funds and several bond funds, for example, rather than just one or the other, you will achieve greater diversification. Asset allocation is a concept that is closely related to diversification. It entails deciding how much of your portfolio to invest in each asset category or type of security based on risk and other factors. Another general rule is that the younger you are, the more risk you can take because you will have more years to compensate for any losses. Start with a plan. Making a financial plan is the first step toward building wealth. That entails taking the time to identify your goals and plan out how to achieve them. Wealth creation begins with a vision and a plan, explains Peter Casicota, owner of Asset Management and Advisory Services of Lee County. Hiring a financial advisor is an excellent way to get started on your wealth building strategy. It's a more expensive option, especially for those just starting out, but hiring a certified financial planner or CFP means you're paying for planning expertise. Looking for a robo-advisor that provides financial advisors access may be more cost-effective option. What do you think about these tips to build wealth? Let us know in your views in the comments below and make sure to subscribe to Shareholdr for more such videos.